Hello there, my name's Thomas O'Regan and I'm a property investor here in Australia. Now, as far as I can see, every type of property in every area has a set compounding growth rate. Now, that compounding growth rate can range anywhere from 1% per year to 5%, 6%, 7%, 10%, and even 13% per year. Now, I'm just going to give a few examples of type of properties that would be increasing by a capital growth rate of 1% per year. That a property that is getting a compounding growth rate of 1% per year may be something like a serviced apartment in a highly dense area or regional town, something like that, like a serviced apartment style, short accommodation stay, thing like that. Now, the thing with areas and compounding growth rates for types of properties is when I'm saying a 1% compounding growth rate, I don't mean every single year the compounding growth rate is 1%. Property market cycles are cyclical. Okay, they go up and they go down. Some property market cycles are 7 years, some are 10, some are 15, some are 20, some are 25. Okay, so it's not like if you are investing in a property that has a 1% compounding growth rate, every single year it goes up by 1%. More commonly, properties like that, the compounding growth rate almost can be flatlining for 10, 15, 20 years, and then all of a sudden over a 2-year period, it just doubles, triples, quadruples. Even though traditionally it is, or over a long period of time, it is growing by 1%. If a property growing by 1% has no growth whatsoever over a 25-year period, then there is a point when that property will just explode in growth to catch back up with its compounding growth rate. Now, on the flip side, and these are typically properties that people say you do not absolutely do not invest in, you do not make money in them. They're just very volatile properties that if you understand how the market cycles work for them, you can make a lot of money. But if you're building a large property portfolio, it is something I would not focus the majority of my property portfolio on, but just a small piece of my property, okay? Because it is a riskier type of investment. So next type of investment, let's just go up to the 5% compounding growth rate. Now, the good thing about the 5% compounding growth rate that I think you guys should know is about 90% of properties in Australia grow by at least a 5% compounding growth rate. And if you compare that, if you're using leverage to buy a property, a 5% compounding growth rate is far better than what it sounds. Okay, so for example, if you're only putting in, I'm not going to work out the maths, but hopefully you guys get the concept. If you're putting down a 10% deposit on a $1 million property, and that is costing you $100,000 to buy the property, that's $1 million, and you are getting a 5% compounded growth rate on the property's value, which is $1 million, then that is an extra $50,000 per year. What, in terms of return on capital, that is actually I think it's a 50%, yeah, a 50% return on capital. That is a huge return to get, even though the actual compounding on face value, when you look at it and you say that's getting a 5% compounding growth rate, that it doesn't sound like a great investment when you compare it to stocks. You're like, why don't I just invest in a stock that's getting a 12% compounding growth rate? Because stocks are not leveraged, therefore the return on capital is far lower, right? So that's the cool thing about property. Now, 7% capital growth rate in Australia is where most people look to invest in property, okay? So they're looking for properties that are getting a 7% compounding growth rate. They're looking for a better return than average, and typically these properties come with a little bit of negative cash flow territory. So I prefer to invest in properties that typically are getting like a 5 to 6% compounding growth rate, and I'll invest in these properties cyclically. So I'll invest in them in the period of time when these properties are in the market cycle where they're about to have a lot of growth. To understand this sort of stuff, you need to do a lot of research. Now, let me explain why I prefer to do that rather than invest in properties that are having traditionally or typically a higher return with a negative cash flow. Because if you are buying properties that are attracting or that have a negative cash flow, you are severely limiting your capacity to build a large asset base. So you're severely limiting your capacity to build a large property portfolio, because every time you buy a new property, it is costing you a huge amount of money to hold it, a huge amount of money in the bank size to service it, and if you keep going down that route, you will ultimately need to continuously increase your income by a large amount every time you buy the new property. So most people, by increasing their income substantially each time they buy a new property isn't possible, right? But if you are buying properties on the other side that are lower, typically lower compounding growth rate, but they're cash flow neutral or cash flow positive, then it doesn't matter if you're on a low income, because the properties are kicking off extra cash flow as you buy them, or maybe they're just neutral enough to look after themselves in terms of finance, in terms of costs. Now, what's the actual upside of investing in those type of properties? Well, as I said, if you invest in them cyclically, then they can double in a very short period of time. Like, for example, yes, it may be a 5% compounding growth rate over a 30-year or 50-year time horizon, but if you understand market cycles, you could be investing in the property when it's at the point where it's had a terrible compounding growth rate, maybe like a 1 or a 2% compounding or 3% compounding growth rate over the last 20 years, or let's just call it 7 years, but it's picking up to a period where it's going to have a period of 2 or 3 years where it's getting 20, 25, 30% compounding growth rate for that short period of time. And that's when I invest in properties. I get a huge capital injection. I use that capital to reinvest into more properties. I build my asset base larger than anyone could, but that would be buying negative cash flow properties. Now, there is types of properties that get a far better return than any of these other compounding growth rates that I've talked about. It's like 12, 13%. There are properties out there that over a 30 or 50-year time horizon, they are literally getting a 12 to 13% compounding growth rate. Now, for me, definitely, I think to purchase one of these properties that are getting such a huge compounding growth rate over a 30 or a 50-year time horizon is something critical to add into your property portfolio if you're looking to create extreme wealth in your life. These type of properties are typically in obviously blue chip areas, and they are like, there's something about these properties that is just, you cannot beat it. It's like the best view in the suburb, or, all that sort of stuff, where it's like closest proximity to the city, or it's beach views, or it's like, the only house on either side of the national park, so it can't be built out. Like, you have views of the ocean and there's no one in front of you or next to you, and you can see the entire ocean 360 or 180 degrees. Those type of properties, I definitely want to add something like that to my portfolio eventually, because honestly, it only takes, if you buy one property like that in a 50 this day and age, for say like a $5 million price point, that one decision will make you a billionaire. And if you can buy it as a principal place of residence, you could potentially sell that thing and get no capital gains tax. So the entire profit from the property, the sale of the property, would be you would not get any tax on that, which is absolutely absurd, right? Where do you go from there though? Like if you sell an asset that is, you know, like it's like it's funny, you know, if you it almost doesn't make any sense to sell property like that, unless you're just moving that money into another more desirable asset that is getting the same amount of growth. But otherwise, I can't see any reason why you would ever sell that asset, which in a way kind of defeats the purpose of buying it as a principal place of residence, to not incur the tax, because it's like, if you're not going to sell it, then you're never going to incur tax. Then what does it matter if it doesn't get taxed at a 30% rate, which, you know, is what other investments get taxed at. Anyway, guys, I'll see you next time. Bye.